How much did you make this year?
0.
You sold a property 7 months ago. What was the capital gain on that property?
0.
View team, we have a problem. Somebody is not paying their taxes. You have the green light to engage.
Everyone reporting.
Alpha team in position.
Bravo team in position.
Echo team in position. Please hurry up before I get massacred. Okay, go. Stop the front. Down. I repeat, the scammer is dead.
That's what you get for not paying your taxes. Mission accomplished.
This could have happened to you if you fail to pay IRS taxes. To avoid getting murdered by IRS and yet legally save on taxes, here are 6 tips I like to share. The general rule is that if you want to pay fewer taxes, you must lower your income. The easiest way to achieve this is to quit your job and live off food stamps. This way, your income is 0 and the IRS will not bother you. Of course, that's obviously a joke. For majority of us who have income, stay tuned. Seriously, if you want to pay fewer taxes, you must reduce the amount of income the government considers taxable. This does not mean you must make lesser money. It just means you have to move your income to somewhere else to be considered to be non-taxable, which is known as tax-exempt income. You'll pay less in tax if you have more tax-exempt income. You'll want to maximize all of your tax deductions. The more tax deductions you claim, the lower your tax bill will be. Did you know that super rich people like Jeff Bezos, Elon Musk, and Warren Buffett don't pay taxes? This is because their wealth grows through their ownership of shares in their company, and capital appreciation of assets is not considered as income if you don't sell those assets. Tax laws are slanted in favor of investors and company owners, which often appear to be unfair. Although we can't all be like Jeff Bezos, there are many methods to lower your tax burden, even if you don't own a business or have a lot of money. 401k plan. The simplest approach to lower your taxes is to deposit money into a 401k plan. You owe taxes on whatever you earn as soon as it enters your bank account. But with a 401k, the IRS allows you to contribute a portion of your salary first, and then they will charge you taxes on whatever there's left over, allowing you to invest with tax-free profits. In general, you owe taxes on everything you make as soon as the money comes through the door. But with a 401k, the IRS lets you contribute a chunk of your paycheck to the 401k account first, and then they will charge taxes on whatever's left. The end result is that you get to pay much lesser tax. Let me give an example. If your salary is $4,000 each month and you allocate to say $400 of that to your 401k, you won't get taxed on your full $4,000. You'll only be taxed on $3,600. Let's say you are in the 22% tax income bracket. Your tax payable will only be 22% of $3,600, which works out to be $792. You will be able to save money so much faster if you use your 401k account. Even better, for those of us who are employed, your company may have a 401k matching scheme. If you happen to be employed, which most of us are, and your employer has a 401k matching scheme, take advantage of that. It's free money for you to take. The most common match by employers is 50 cents on the dollar. For every $1 you contribute to the 401k, your company will contribute 50 cents. Sounds like a great deal, right? But companies are not stupid. Of course, there will be a certain limit to that. Let me show you some statistics. About 71% of companies with matching contributions contribute 50 cents for every dollar their employees contribute, and their limit is usually up to only 6% of their pay. And another 21% of the companies out there match employees' contributions dollar for dollar, but of course the limit is just 3%. One thing to keep in mind is that 401ks are designed to help you save for retirement, so you won't be able to touch it until you are 59 and a half years old. However, there are some useful things that you can do with it. You can use it to make large purchases like buying your first home. You can also use it for tuition fees. But if you take it out, you have to return it back. It's considered a loan from your own 401k account. The good thing is that instead of paying the bank interest, you're paying yourself interest. But hey, I'm not happy with this arrangement. 401k is my hard-earned money and I should be entitled to use it however I want. This is a free country. Yes, you might be unhappy with the limitations, but remember, 401k is meant for your old age. This concept will apply to many of the upcoming tax saving strategies that I'm about to share because government likes to reward citizens for saving for their retirement. Whether you like it or not, when you're old and your hair turn white, it's going to be hard for you to find a job. Nobody will employ you. You definitely need a source of income. And 401k is designed to fill that need. Your future self will thank you for it. So why not take advantage of the tax benefits while you're at it? SEF IRA. You can only open a 401k if your employer offers it. So if you don't have a 401k through employment or if you are self-employed, this tip is for you. The Simplified Employees Pension IRA, also known as SEF IRA, is the equivalent of 401k. It is designed for the self-employed, freelancers and company owners. It allows you to put up to 25% or up to $58,000 of your net business income into a tax-free investment account. You are entitled a tax deduction for whatever amount you contributed. Many self-employed people and freelancers out there are unaware of this. So if you have not done this, be sure to open a SEF IRA immediately to maximize your tax saving. HSA. Take a look at your healthcare bill. How much was it last year? I hope it's zero. The question is, will it stay zero moving forward? Nobody knows. We never really know when we will fall sick or get injured. But one thing's for sure, the older you are, the more health problems you're likely to get. That's why it's a good idea to set aside some money for healthcare. This is where a health savings account, also known as HSA, comes in. A health saving account or HSA is similar to 401ks and SEF IRAs. Any contribution you make immediately reduce your taxable income. However, HSA are a little different in that they are intended to help you pay for health-related expenses with tax-free money. The good thing about HSA is that you don't have to wait until you're retired to use them. You can use them for health-related expenses right away. HSA contributions can be made through payroll deductions or from your own cash. If made through payroll deductions, even if you don't itemize, they are tax deductible. If they are made from your own funds, they are considered to be made on a pre-tax basis, meaning that they reduce your federal and state income tax liability, and they are not subjected to FICA taxes either. This is one of the primary reasons why HSA is a better retirement vehicle than a standard 401k or IRA. For 401k or IRA, regardless of how the funds are utilized, once you start withdrawing cash from such programs, you must pay income tax on the money. Withdrawals for qualified medical expenses are tax-free. The key way in which HSA is superior as a retirement vehicle as compared to a traditional 401k or IRA. This is because the traditional 401k or IRA, you have to pay income tax on those plans regardless of how the funds are being used. Because of the way HSA function, it can be a fantastic investment vehicle. When you contribute, you will save money on taxes and your money will grow tax-free. If you can keep your HSA money in your account until you are 65, you can use it any way you choose. HSA is an underutilized account. Many people with HSA had an average balance of just $3,221 in 2019. Which is actually very little, given that the maximum yearly contribution in 2021 is $3,600 for those with solo health insurance. Furthermore, just 6% of HSA were in investment accounts. Almost no one contributes the maximum amount, and almost everyone takes current payouts to cover medical costs. All of this implies that those who have HSAs, as well as those who are eligible but haven't opened one, are missing out on a fantastic way to save for retirement and save on taxes. So be sure to check it out today. Municipal bonds. Moving forward, let's discuss some ways to make income without paying taxes. Municipal bonds, or munis for short, are debt securities issued by state, cities, countries, and other government entities to fund their day-to-day obligations and to finance capital projects such as building schools, highway or sewer system. By purchasing municipal bonds, you are in effect lending money to the government entity in exchange for a promise of regular interest payment, usually semi-annually, and the return of the original investment or principal. Short-term bonds mature in 1 to 3 years, while long-term bonds won't mature for more than a decade. Municipal bonds interest is tax-free from the federal income tax. If you live in the state where the bond was issued, the interest may be free from state and local taxes. As of today, August 2021, you can expect to make around just 1% for a 10-year duration muni. This does not sound like a lot, but if you consider tax benefits, the yield is actually much higher. If you still think it's not as much as you want it to be, you can consider investing in this space in the future when prevailing interest rates are higher. 1031 exchange. When you invest into a property and if that property appreciates, you need to pay capital gain tax once you sell it. Assuming your property gain is around 100k, you have to pay at least 15% of capital gain tax. So that's 15k taken away from you. 15% is quite significant. Paying taxes on your hard-earned money is a very annoying experience, but no worries, I will show you how you can avoid this without the IRS coming to murder you. Section 1031 of the US Internal Revenue Code allows you to avoid paying capital gain taxes when you sell an investment property and reinvest the proceeds from the sale within a certain time limit in a property of like kind and equal or greater value. Take note, Section 1031 benefit is not available to sellers or buyers of personal homes. Even a second home that you live in sometime is eligible if you don't treat it as an investment property for tax purpose. It's more for people who invest in real estate, so don't use this for your personal home transactions. Roth IRA. Another option to avoid paying taxes on your assets is to open a Roth IRA. A Roth IRA is an individual retirement account that offers tax-free growth and tax-free withdrawal in retirement. Roth IRA rules dictate that as long as you own your account for 5 years and you are 69.5 years old or older, you can withdraw your money whenever you want to and you won't owe any federal taxes. Any money you put into a Roth IRA is never taxed again. Any stocks, bonds, or other assets you have in a Roth IRA can grow tax-free until you retire, and any income or withdrawals you make from your Roth IRA will be tax-free as well. It sounds great, right? But of course, there's a limit to the account maximum size. In 2020, the limit for singles is $140,000. For married couples, the limit is $208,000. The amount you can contribute every year is limited as well. In 2021, the contribution limit is $6,000. If you are age 50 or older, you can deposit up to $7,000. At any time, you may withdraw contributions from your Roth IRA, both tax-free and penalty-free. If you take out only an amount equal to the sum you put in, the distribution is not considered taxable income and is not subjected to penalty, regardless of your age or how long it has been in the account. But if you want to withdraw earnings, there are limitations. To withdraw earnings without any limitations, you have to wait until you are 59.5 years old. Almost all brokerage firms, both physical and online, offer a Roth IRA. So do most banks and investment companies. So be sure to ask them for it. And that's it. Agree or disagree with my video? Is there a better way to legally save on taxes? Subscribe, leave a like, and comment down below. And I'll see you in the next video.